Everyone, so welcome to Single Value. So today I want to talk about Palantir. So Palantir is coming onto the market on the 29th of September and is likely to be a valuation of above $20 billion. So we're looking probably maybe 22, 23 billion, though we're not quite sure entirely yet until they set the pricing. It could be easily revised, just like Snowflake. Snowflake had a valuation about an IPO pricing of about $80 to $85, then it got dramatically up to like $120, so about 50% higher. So we could see a situation of Palantir where they have a valuation of above 20 billion, though it could easily be up closer to 30 billion. But I'm looking at this company and I'm feeling like it could be worth a bit more than that. So let's look at the financials and I'll tell you why I think this might be the case. So if we look at the financials of the 2018, revenue was 595 million, 2019 revenue was 742 million, and we're looking at a growth of about 24%, which wasn't actually very high in a sense, but in the recent 6 months of the financials, 2019 was 322 million for 6 months, and 2020 it was 481 million for the 6 months leading up to June, and it's showing a 49% revenue increase. So all of a sudden the revenue has just doubled in a sense. So it is a good sign when a company can increase its revenue by that much, because we're looking at this company and as it's getting bigger, you likely feel like the revenue growth might slow, but it's great to see the recent revenue growth. Sometimes this comes with product changes or signing up customers just taking a bit longer than expected, because at the end of the day they do get into very sensitive type of contracts, and negotiations and terms and conditions do take a long time to actually get done. So we're looking at this and the recent growth is a very good sign. And if we look at the total operating expenses, we're looking at about a cost structure of $1 billion. So if we're looking at 2018 or 2019, both were slightly above $1 billion, but very consistent. And same thing with the last 6 months of 2020, we're looking at 517 million, double that, and it's $1 billion too. So overall, this company has this cost structure of about $1 billion, and it doesn't need to change. That's kind of like the beauty of software. The minute you create something, you don't actually need more to manage it. You just can maintain it, and as long as you can sell more of it, you just make more profits. But if we look at the losses for this company, they're not quite in that profit territory yet, though I'll point out something that is a very good sign. So overall, their losses were pretty similar in 2018 to 2019, though recently with the strong revenue growth in 2020, the loss has gone from 2,080 million to 164 million for the 6 months. But if we look at the situation where we take out the stock compensation costs, they actually made a profit, which is quite a surprising fact. So we look at the 6 months for 2020, the loss was 164 million, including stock compensation costs, where stock compensation cost was 181 million. If we put that back in, we actually end up with a positive figure of about 16 million. So it's quite, it's quite good, isn't it? When we look at this situation, in the sense that if we actually took out the stock compensation costs, we actually end up with a company that actually made a profit, and on top of this growth. But never mind that to be the case. If they didn't make a profit this year, if including the stock compensation costs, it is overall a still very good situation where they're lowering their losses as their revenues grow. And recently Palantir gave some forecasts that they expect the third quarter revenues to be about 278 to 280 million. That would represent 46 to 47% growth on the prior year. and overall they expect to do $1 billion in revenue for the current financial year, which would represent a 41% growth, and they expect at least 30% growth in 2021. So overall, fairly good projections going forward. So we can look at these numbers, and if we go, if they keep $1 billion as a cost structure for the next financial year, for this one, they would likely break even, or more or less break even. But that's including stock compensation costs. If we minus stock compensation costs, this company actually ends up making a really decent profit. And if they grow 30% next year, which will be on this $1 billion projection, they're likely to end up with about 1.4 billion in revenue. And when you have a cost structure of about just over $1 billion, we're looking at it maybe even 200 million profit next year. So it is a very, very good sign where this company is heading, and we just have to see if things actually pan out that way. But overall, they have such a huge pile of cash that the losses actually don't really matter as much. We're looking at around about 1.5 billion for at the end of June of 2020, and yeah, I think overall the company's in a very good state in terms of revenues, in terms of its cash position, its future in terms of projected growth, and if we minus that stock compensation costs, we can see this company's in that green territory, which is a very good sign. And if we look at revenue growth over time, we can kind of see like from the last few years, revenue hasn't actually been as consistent. So like here, we can see this big jump in revenue from 235 to 364. But whereas the 177 to 235, it wasn't as big of a leap. And then the same thing here, from 466 million to 515 million from 2016 to 2017. The growth in revenue is actually very inconsistent, so I wouldn't take it like a normal company where the revenues grow at a consistent rate, and when it diminishes, it's not likely to grow further forward in the future. Like this company is actually different. The growth could be slow this year, but it could increase next year, and it could increase next year and then slow down the year after, and then it just increases after that too. So it's, I wouldn't take drop in growth to be a bad signal entirely. I think it's just the nature of what this company does. Basically, these contracts do take a long time to negotiate, but they are worth a lot. As we see here, they had 125 customers, and that's going to help them generate about $1 billion in revenue, which is incredible, right? So, these are big contracts. They take a long time to discuss, but once they land these contracts, it is a big revenue source for these guys. If we look at this chart here, the average top 20 customers last year gave them about 25 million each on average. So that's an incredibly good sign, and since 2019, these top 20 customers have on average been with them for 6.6 years. So if anything, their customers stay with them for a very long time. It means they have a very good moat around what they do, particularly if we look at the average revenue they charge per customer. It is increasing every year. So like this company is providing more value to its customers, and it looks like it's able to increase costs as it goes as well. So you kind of feel like, even if they keep the same amount of customers, as long as they keep charging them more, they just get a natural rate of growth, and that just proves a very strong moat when you're able to charge a customer more and they still stay with you. It's a very clear sign that what you're doing is very, very good. And if we look at the contribution margins, overall really good as well, has been increasing over time. But as they point out over here, in 2019, Here they kind of have like their revenue, their margins to be like 14, 18, 15, 33%. Whereas if you actually take out the stock compensation, which I was pointing how this company is actually in the green, if you actually take out that cost, their margins are actually 67 to 71%, which is incredibly good. So overall, I think if you got some time, definitely spend some time looking at this prospectus. There's a lot of goodies in this, and I think overall it's showing this company is one with a very strong moat, growing at a very good rate, and it is very favorable with its customers, and good for forecast for the future if we're getting 30% next year. I think the one big problem they have is ceding control of this company and providing the transparency that investors kind of want. So right now it's in its fifth filing is because they keep getting the wording wrong, or they keep putting wording in that kind of looks like they just have unlimited control in this company. So currently there's 3 founders, and they do control about half this company's voting power. And that's kind of what you want, because you don't really want to cede this company to control of someone who might use it in a bad way because of how significant this company is in terms of national security. So hence why they're having a bit of trouble trying to really get this structure perfected and be very clear with their wording. So I think, again, you just take these mini filings as a point where not even the founders know how they wanted to set this structure, but once you set it, you really have to keep it there, or else you could face the wrath of your shareholders. So hence why the company is still working through these things, but again, for me, it doesn't feel like it's going to be a big problem. I think it's just a normal way of things. Just like they have inconsistent growth rates, they're not likely to be able to be as transparent as a normal company in terms of how they do things, though you do want them to be a bit more transparent when it comes to this voting structure, because at the end of the day, as a normal shareholder, you would still want to know how the power dynamics work with this company. But in terms of valuation, I'm very happy with the financials, and if it does come out of 20 billion valuation, I feel like it's a company that I could buy into. I kind of see this company being valued probably at a 50 billion valuation, given what Snowflake has produced, given what JFrog has produced. I kind of see this going in the same valuation as these companies. So I kind of see a 50 billion valuation for this company. We'll see how it goes. But yeah, I think the pricing is going to be revised to about 30 billion. And so I think it gives the IPO pricing a bit more meat on the bone, and then when it comes on the market, I think it's going to do very well. I think the name itself is a big seller because of how well known it is, what they do. There's such a strong moat that the revenues don't look like it's going to be decreasing anytime soon, and they have very good pricing power, and they're showing really good growth. Definitely let me know what your thoughts are, or if you have any questions. Until then, good luck investing, everyone.